So what in the world is going on with mortgage rates? Look, we are basically a tick away from the highest rates that we've seen in 22 years. So that's what we're going to talk about today. My name is Dan Free. I do this report on a daily basis to inform you guys what's actually going on in the economy and how does that affect real estate. So I really don't know what's going on with home prices because if you're on the West Coast, your home prices are crashing. If you're in the middle of the country or even parts of the East Coast, we're actually seeing prices rising or continue to rise. So it's a conundrum. So if you're out there and you're looking to buy your first house, please reach out to a realtor in your area to see maybe is it a good time to rent or should you should you rent or should you buy? What's more affordable for you and your family? So first thing I want to go is where mortgage rates are and the whys behind all this. So when we really dig into this, there's basically a disconnect right now. And the reason for interest rates going up and up and up is I really don't know. And the markets don't even know. So let's get over to it. So you see right here, these are the top 6 programs that people use when they're buying or refinancing a home. But we're going to get to that in a second. Let's go over first and see why all this is happening. Well, it's all about the Fed. And that's why my videos on a daily basis, I'm trying to get to the point where I'm trying to give you a little bit of excitement and some new content. But it's all about the Fed. Nothing but the Fed. So we have yesterday what happened in the markets. Well, the 10-year Treasury yields rose as investors digested the Fed minutes. So here's what's happening. The Federal Reserve comes out and they do their meeting. They did it a couple weeks ago. They come out and they tell us what they're going to do. And then they release their notes, all the notes that they all discussed. And a lot of them said, well, if inflation still continues to rear its ugly head, we're going to have to continue to increase rates. We get it. But a lot of the data that's coming in last week, the CPI, which is consumer inflation, and the PPI, it's producer inflation, is still saying that the numbers are continuing to come down. But the scare on my part is oil, as you guys know. So let's really start breaking down, the yields and the yield curves and all the things that they talk about on Wall Street and a lot of the economic channels. So the first thing I want to go over is I do a newsletter every day. So if you want to get informed on what's going on in the markets and you want to get it in digital form, please subscribe to my newsletter down there. I don't sell the data. There's no charge to it. It just gives you daily information and then recap it on Friday of kind of what the markets are doing and why they're doing those. So there's my picture and there's my newsletter. Let's go over to the yield curve. A lot of people talk about the yield curve. Well, the yield curve is inverted and it's this and it's that. What in the heck is the yield curve? Well, basically, it's giving us the yields on different maturities of investments. So if you're looking at, what I mean by that is a short-term yield is maybe a 2-year or a 1-year bond, okay? And then the long term is a 30-year bond. So what you're seeing on your screen right now is what they talk about when they're talking about the yield curve. So I pinned in here 3 different time frames. At the bottom in blue, you have 2021, what the yield curve looked like. In the green is where we were in 2022. And then the red is where we are right now in 2023. Look how far rates, the short-term end of the maturities, went from basically zero when everything was basically the Fed was at 0 interest rates, mortgages were at like 2%, and credit card rates, everything was really, really cheap. And that's why a lot of people financed things and bought stuff. And then as the Federal Reserve moved, they continued to increase rates. They increased into 2022. And here's what you see. So what this is giving us, like I said, is where the short-term yields are and the long-term yields. So you can see right through here, short-term rates are lower than long-term rates. That's normal market. Same back in 2021. Short-term rates were basically 0 and long-term rates were 2%. And that's how we got 2% mortgages. Okay, but let's go into now where it's inverted. And this is what they talk about when they say the yield curve is inverted. Now we have short-term rates. Look at it. They're like 5.5 on short-term rates. But you go over to long-term rates and they're at what, 4.25? So this isn't supposed to be this way, folks. When you invest in the long term, you want higher yields if you're going to tie up your money for a longer period of time. So people were saying, the Fed's going to continue to raise rates. That's pushing up short-term rates. Thus trying to cool off the economy while long-term rates are basically stagnant to this point. So that just gives you a little education on what in the heck the yield curve is. It basically gives us where short-term yields are and long-term yields. That's why a lot of people, when they call in, they're like, Dan, what are adjustable rates looking like? Well, they're higher than long-term rates. So it's most likely that you're going to get a much better rate on a 30-year fixed than you would a 1 or 2 year ARM, and this is exactly why. So let's get over to the next thing I usually concern myself with. I haven't done this in a while, but I want to show you guys the disposable income. Here is why we have inflation today. Okay, so I want to go back in time. What disposable income is how much you and I have after we pay our bills and everything else. How much is left over? How much are we putting in the bank? Well, if you look through here, this is from the federal government. And so if you're a conspiracy theorist, you're going to say, well, this data is flawed, but it's coming from the federal government. What we want to go through here is, hold on one second. This scan is going through. Let me cancel that out. And so let's get over to where So let's get over to what happened. So if you see this chart here, and I always used to say, if you're like in Sesame Street, if you're looking at a chart and just something seems off, so you're looking through this, and this is our disposable income. Start through here and through America, people started saving in the 60s to make a better life for their family, and they were able to save. And then all of a sudden you get right through here. What in the world, what spiked this thing? Well, let's get over to here and let's look at a 5-year chart. Look through here. It was increasing, like it was steadily increasing. Then all of a sudden, whoa, this thing just spiked. And then all of a sudden it went down a little bit. And then all of a sudden, wham, it spikes again. What happened during these times? Well, if you look back in 2020, what happened? COVID. What happened at that time? The government kept pumping money out to families. Remember, you guys used to get checks, every so often. And if the more kids you had, the more people in your family, the bigger that check was. Also, what happened where a lot of people didn't ever, and I was on people's YouTube channels on this and talking about this all over the place, and people thought I was crazy. They were like, what are you talking about? I said, this is going to cause inflation. Why? We got too much money out there in people's pockets. People don't save. Okay, as Americans, we really don't save. Most of us are living paycheck to paycheck. So when you get all this extra money, what are you going to do? You're going to buy and buy and buy. Okay, the same thing happened at that time was there was a supply chain issue that drove down the amount of goods and services we had. So you have limited supply of things, and we had a ton of money in the economy. So prices just rallied and they went out the roof. So in June of 2022, we basically saw the highest inflation rates we've seen in decades. This is represented right through here, folks. So that's why I kept saying back in these days, we're going to see huge inflation coming because disposable income has spiked tremendously, and we have that supply chain issues. Those two things are going to cause inflation. Well, the Federal Reserve came in and they, basically sat on the sidelines until, last year when then they started figuring out, okay, we got to start doing something and cool down the economy. So they start jacking the heck out of interest rates. The other thing that's scaring me right now is oil. You guys know how I'm about oil. I'm a freak on oil because every day when I go to the, past gas stations, I'm like, okay, this morning gas was $4 and now it's $4.40. How did it go up this much overnight? Well, we're getting hosed at the pump. Getting hosed at the pump. Hopefully you got that pun. But here's where oil prices are. This is year to date. So we've teetered on right through here. Well, thank goodness we're starting to go down. So if you look at this year to date, oil's up 4%. But over the last month, it doesn't give us the factors there, but we went from $75 a barrel to a little over $80 a barrel. So it's a fairly good increase when it comes to percentages. So this is the one piece of the puzzle that I'm really concerned with when it comes to the CPI numbers and the PPI numbers, the inflation numbers that are going to come out in a couple weeks, because these numbers haven't been factored in yet, and oil just took a recent rally. Let's just go back to a 5-day chart. This is the nice thing. You can see where oil prices here, they're down 3% over the last 5 days, but if you go month to month, it's 8%. Well, this number was about 20% not too long ago. Okay, so that's what we're seeing in that piece of the puzzle. Then here's the one area that a lot of people don't look at. This is the Cass Freight Index. This is how much shipping's costing us. And this goes back to where we were in oil and diesel and all the other fuels and so forth. This is what's going on with freight all over the world. Okay, so you have freight through here. You can see back through here. This is June of 20. Wait, hold hold on. June of 2022 was right through this range here where we peaked, and we come down from that. So this is a little bit good news, saying that the freight indexes or freight costs are coming down and coming down pretty darn good. You can see down through here where it crashed. You can see down through here when we had the pandemic and everything crashed because there was no supplies, there was no goods to ship. Then it rallied and we're about, halfway down from where we were at the tops. So this is all indicating to me that oil's down, coming down. We have the inverted yield curve starting to flatten out. We have a lot of CPI and PPI numbers that are actually coming in pretty good. So all this data is telling us, the Federal Reserve should stay on the sidelines. So, but you're going to continue to see where it says, U.S. Treasuries and investors are really dissecting what the Fed minutes are, and there's a really good chance that they're going to increase rates again. Well, there's a really good chance that they're not going to increase rates again as well. So again, watch for the shock and awe, because you're going to have all mainstream media, it's marketing in general, where they try to get you the shock and awe of like housing market's going to crash. So you click on that button to find out, okay, San Diego's crashing, but if you really look at other parts of the country, it's not crashing, folks. So that's my report for today. Let's go over and see what this information is doing for bonds today. So we don't follow the 10-year Treasury, because why should we when we have a mortgage bond that we can follow? So we watch several different mortgage bond maturities. What this is basically telling me is what the price of the bond is. You're seeing that right here. Okay, so why do we follow this? Well, if you follow the price of the bond, you're going to see what's happening to the yields. So all you need to know is if the price is going down, like we're seeing right here, if prices of bonds go down, there's an inverse. I call it a yin-yang effect. Prices go down, rates go up. Prices go up, rates come down. You can see through here, well, you can't really see the green, but we started off the day way down here. We went up, and so it's too early in the day to really figure out what's going on, because the markets aren't really truly open yet to digest a lot of data. But I'm seeing the markets should be flat. There is no really reason for these rate spikes. And if you go back to the newsletter that I just went out through, here, I'll give you my newsletter. Back through here, it says here, today's federal minutes were uneventful with the volume spike, and we didn't even eclipse those seen in today's 825 CMA report. So, but if you go down through here, this has less to do with the things that happened today and more to do with the general trends of inflation. So everybody's sitting on this, basically the edge of their seat saying, okay, what's the Fed going to do at the next meeting? What's the Fed's going to do at the next meeting? I'm trying to inform you what the Fed's going to do at the next meeting. So based on all this, where are mortgage rates today? Well, they're right here. This is actually where they closed yesterday. These are the top 6 products people use when they're buying and refinancing homes. You can see right through here, the 52-week high was 7.37. We're at 7.34. Okay, so we're just ticks away from being at a 22-year high in mortgage rates. But is this the peak? I'm calling it the peak at this point. Can we see it teeter up a little bit from here? Yep. But my call is still that mortgage rates are going to come down, as well as interest rates are going to come down in the next 6 to 12 months. That can be validated by the Federal Reserve's dot plot. I'm not going to go that. The video is long enough for today, but the dot plot is telling us the Federal Reserve, even from the Federal Reserve, they plan on cutting rates by 1.25% between now and December of 2024. So at what point are they going to start and pivot that rate coming down? We're only going to sit in the sidelines and wait for that information. So if you like my videos and you're like, Dan, what do you do? Well, I'm a mortgage advisor licensed in all 50 states, and I'd love to help you. What we're starting to see right now is a lot of people still trying to qualify, especially in the Midwest, down through Texas and on the East Coast. The West Coast, a lot of the people are sitting on the sidelines because they're like, our prices are so high. So they're seeing, some areas are seeing a decline there, but we're still having a robust appetite for people looking to get pre-qualified. So if that's you, we'd love to hear from you. How you reach out to us is give us a call at 844-775-LOAN. 844-775-5626. Or if you'd like to start, a meeting with us, if you hit the apply now button, we do something a little different. It doesn't send you off to an application. What it does is it schedules you for a mortgage consultation. Now, why do we do this? Well, most people don't know, do you qualify? How much do you qualify for? What is your credit score? How much disposable income do you have? How much of a down payment do you have? So we'd love to talk you through this to make sure you're in a position to actually apply. And then after the consultation, if everything works out, we're going to send you a link and get started on that immediately. What we have right now is a lot of people looking to refinance with home equity loans. They're taking equity out of their houses, and a lot of you guys are saying, okay, all we're doing is, driving people in more debt. I'm not asking you to get in more debt. What I'm saying is be a financial steward of your money. Here's what you're doing. You're paying probably 20 or 25% interest rates on your credit card payments. Maybe look at a refinancing or getting a home equity loan at probably half that rate to pay off those high interest rate credit cards. I'm not saying get in any more debt. I'm just restructuring that debt to make sense for you guys. So that's my report for today. Please reach out to us if you need any assistance with a mortgage, getting pre-qualified, maybe a reverse mortgage, or looking to consolidate some debt. We'd love to help. So I'm going to ask you to do 2 things today. 1, give me a thumbs up if you like the video. And 2, if you haven't subscribed yet, please subscribe to my channel down below so you can get alerted every time I post a video. God bless, guys. Thanks so much for watching. Bye-bye.